Kathryn Rooney Vera. She's head of research and strategy at Baltic Capital Markets. Kathryn, thank you very much for joining us this morning. I've read in some of your notes that you believe that given the record high stock markets and given the Fed's stated aim of stimulating the U.S. economy, you're looking increasingly at alternative spaces for investment opportunities. This includes things like private equity, venture capital, real estate, hedge funds, and crypto as well. Tell us more about this pivot.
And I'll add commodities in there too. The correlation with the broader, more traditional equity and fixed income markets is low, and in some cases is very close to zero, depending on what alternative asset class we're talking about. And we think this is an important thing to consider in an individual's portfolio, given the fact that we're at all-time record highs. And the market is certainly dependent on ongoing stimulus, both from the fiscal and monetary front. In the event that things were to change, particularly on the inflationary environment, we think that a move up in Treasury yields, higher Fed funds rates, and kind of that fear-induced move in a change from less accommodative policy over the course of the next year and a half would lead to a slide in risk appetite. And if that's the case, we want to be properly hedged. The concern that we have, however, is that timing is difficult. So what we're recommending clients to do is maintain their long risk positions and hedge them with either Treasury inflation protected instruments, gold, sectors or companies that benefit from an inflationary environment, and most certainly add into a diversified portfolio this alternatives asset class.
What commodities do you like the best? Copper has received a lot of attention recently. Which commodities do you think present the most opportunity right now?
Well, we do like having a position in gold. We think that Bitcoin has taken a lot of the luster from gold. A lot of money has been moving into cryptocurrencies at the expense of some of these precious metals. But that said, once we do get that inflation pop, we do think that there will be a lot of flooding into this more traditional asset class. We also like the broader commodity index, a combination of ongoing low interest rates on the global horizon, plus the reopening of the entire global economy at different paces, but certainly in the developed markets, that's ongoing, as well as in China. The demand for commodities is strong. And with a weak dollar that we think structurally is going to remain weak, given the twin deficits and the constant indebting of the U.S. government without financing these deficits, is going to be structurally negative on the dollar. All of that is positive for commodities.
Seems each week we get news of greater acceptance of cryptocurrencies from established parts of the economy, established players in the financial sector. Recently, PayPal and Visa have both let it be known that they will begin to allow customers to settle their transaction in Bitcoin. Tesla allows Bitcoin payments for its vehicles as well. What's this telling us about cryptocurrencies, and what level of exposure to cryptos do you have in your portfolios?
We don't have any now, and for a lot of our clients, we think it's I'd like to call it volatile. It seems to be one directional in its volatility of late, but certainly it is on the riskier side for many of our institutional and high net worth individual clients. But I will say that there's a lot of interest in it, and certainly as fundamentally we're able to deploy the technology, both blockchain and crypto, specifically with Bitcoin, in the use of, as you mentioned, real companies accepting payment. This definitely solidifies more of a real role for the cryptocurrencies. But we're certainly more in a wait and see mode for cryptos rather than reaching for the stars with this type of asset class. What we're looking at rather is a more moderate, diversified portfolio, which incorporates other alternative asset classes, not just cryptos. We're talking about private equity, venture capital. These are also higher in risk, but the correlation, as I mentioned, is very low with the broader markets. And that's what you want to gain exposure to when the market is complacent at all-time record highs. And these types of securities are not so bid up, right? So when you get guys reaching for more yield, or they're looking for cryptos, we think we should be more defensively positioned. So one of the sectors that we're recommending, for example, is consumer staples. In the US markets, it is probably the worst performing sector, one of the two worst performing sectors year to date. And this is a sector that can benefit from higher inflation. It's able to pass on its costs. And we think that clients should increase exposure to the sector, for example.
Healthcare has also lagged, and I believe that's a sector you like as well.
Yes, healthcare as well. Certainly, it's lagged just recently. Over the past year, it's been one of the big performers. We also like banks. Banks benefit from a steepening yield curve. They're still undervalued, and in the event that we do see the economic recovery continuing in this very aggressively bullish fashion, then that's going to be positive for banks. One thing that we are very careful about, both on healthcare, banks, and the energy front, is regulatory and government exposure, given the administration's focus on perhaps more regulation, higher taxes, and more spin towards non-conventional energy moves. So I think those are the three sectors that are probably more exposed to political and regulatory risks going forward.
And what about green energy? Green energy shares have come off, but you note in some of your recent notes that, of course, the Biden administration looks like it is willing to spend pretty big on green initiatives.
Right, and I think it's a great place to put some allocations, put some money to work. As you mentioned, green energy has come off of its highs. It saw a very steep rally ever since Biden won back in November of last year. It got bid up very aggressively higher, and we've since seen a retracement of about 30% off the highs seen in February, and that came really in parallel with the scare that we saw with regard to valuations when U.S. Treasury yields ticked above 175, and we saw rates on the Treasury market move about 75 basis points higher over the course of 6 months. So there are some opportunities in green energy. It's important to note that the infrastructure package that the administration is currently touting is about half dedicated to investment in green energy. So that's not currently priced into valuations at these levels. And we think, given the amount of government money, taxpayer money, that's going towards green energy, that's a place that's going to see significant upside in the near future, at the expense, of course, of conventional. We've seen the Keystone and Dakota pipelines closed, a preference to move away from fracking and non-conventional energy production on the hydraulic fracking part of it, and more towards wind and solar and green energy sources. So we think that's an allocation that clients should consider in their portfolios.
Okay, why don't we finish with a look at emerging markets? What's your view of non-developed markets?
In the event that the Treasury market continues to retrace in terms of its yield, today we're at 159 in the 10-year Treasury, and that's a welcome respite from what we've seen to be higher yields. Then emerging markets do pretty well. In the event of additional risk-on appetite, emerging markets are really the only place, I would contend, on a global scale where there is actually value. And a lot of that has to do with the fact that Brazil is one of the worst places in terms of COVID and the pandemic, problems there that we see in the world. So there's still certainly a ways back in terms of vaccinations and coming out of the crisis, but a lot of that is already baked into market prices. So the combination of low rates for probably the next 6 to 12 months, economic recovery, and a weak dollar, stronger EM currencies bodes well for emerging markets right now. As I say, a lot is already priced in. So if your horizon is 6 to 12 months, then I think emerging markets at the current levels pose a very good opportunity to invest.